It's interesting to see that two parties that define themselves as populists, the Five Star Movement, the Lega, have become the largest parties in Italy, despite a pretty decent growth backdrop in Europe and in Italy as well. And this kind of goes to show that there is an underlying sense of dissatisfaction among the electorate in terms of how things have been going on the ground, the level of dispersion of wealth and wealth disparity within the various classes in Italy. Now, these parties don't have a lot in common. They have been advertising very different themes, topics, views over the course of the campaign trail. And arguably some of the things that we have seen in the program that they've published may not necessarily be implemented. But one thing for sure is that they are going to have a more confrontational stance towards Europe, towards the eurozone, towards the project of Europe, and perhaps bring into question the institutional framework across the eurozone. There's been some talk that what this means for a euro crisis. Does this combination of Lega plus Five Star mean that we're going back to the 2011-2012 period? It clearly brings a lot of bad memories for the markets and for investors. And we would argue that that's still a very far-fetched argument in light of a few elements. First of all, the coalition between the Five Star Movement and Lega is all but united. They are two different parties with two very extreme sets of views. So it's inherently unstable in itself. And we will see how much of the things that they've promised as part of the program they will actually be able to implement. Secondly, unlike the time when we had the euro crisis a few years ago, today the ECB is still there, is a very, very big actor across all European fixed income markets, even though the QE program is gradually being phased out. The ECB will still be there with reinvestments that will make up a very, very large flow of purchases in the eurozone fixed income markets and support government bonds. And lastly, there are a whole set of checks and balances both in the European constitutional framework and in the European rules, as well as in the Italian constitutional framework, that will prevent some of the more extreme views, the more extreme plans from being implemented, in our view. We would say that the current movements that we've seen, the latest movements that we've seen in BTPs, where spreads have gone from some very tight levels of around 110 basis points versus 10-year bonds in Germany, to just under 200 basis points at the moment, are justified. Arguably, the market had gotten itself a little bit too comfortable with the political risk in Europe, even though we knew that the two parties were going to try and form a coalition. And nevertheless, we have seen spreads going from the widest levels recorded last year of just over 220 basis points between BTPs and bonds to just over 100 basis points a few weeks ago. So it's been a very complacent market that got us here, and the recent developments have actually been a bit of a wake-up call for investors that the political risk is there and has to be accounted for also in prices. Now, looking ahead, we still remain a little bit cautious. There is still room for some more widening and some more volatility, because at the end of the day, we are trading on headlines, and the situation remains very very fluid. On the other hand, however, it's unlikely that we will see, at least in the near term, a replay of the European crisis, because again, there are a whole set of factors that are very different today from where we were in 2011, 2012, that make the market better supported. So the Italian economy has actually recovered reasonably well from the depth of the crisis, and together with the European and the global recovery that we have seen in the last few quarters. And this is one of the reasons why we think that the current backdrop doesn't really justify an excessive amount of distress or panic in the market. But repricing is fair, but and in a context of a positive growth, the latest numbers see Italian economic growth at around 1.5%, and that's a far cry from the very negative numbers that we had seen in 2011, 2012. So the economy has improved, but there are still things that make us wonder a little bit, especially in the fact because the Italian economy has actually lagged the rest of the eurozone, and this is due mainly to two factors: the fact that productivity hasn't really recovered, and there has been a lack of competitiveness, particularly in the labor market, compared to other economies. These elements were all being addressed by some of the reforms put in place by the previous government, and it's a bit challenging to see them being potentially reversed by the new coalition. What this means for BTPs is that at the end of the day, whilst spreads have widened already, there is a case for some more widening in the months ahead, and even though yields may be capped, one thing for sure is that the volatility that we have had over the last few weeks is something that we're going to have to live with for quite a few more months.